Yeah, here we go.
Hello, everyone, and welcome to our final presentation in our course. I'm here with Matty Alon, who's
Hey guys.
co-hosting with me. He's just really just going to sit in, and I will be hosting the presentation as normal. As usual, just let us know that if you can hear me and where you're from. Let everyone. It's always interesting to see the different places that people are joining us from. I can see there's a Germany, a South Africa, Ireland, Denmark, Greece. Hello to you in Greece, Sweden. Wow. All over Slovakia, Scotland,
I'm gonna
UAE.
be in Greece next week, so I'm excited.
Ah, nice. Manchester, Costa Rica.
Oh,
All
that's
over the
even better.
world. That is amazing. We're just going to give it a minute or two just to let, if there's anyone who's not already here, join, and then we will start. I think we're almost ready. So, as I say, this is the final presentation of our advanced aspects of trading course number 10, aiming to win, putting everything together. So, if you've joined us for all of these, thanks very much for putting the time and effort into trying to improve your knowledge, get a wider view of trading the markets. Now, over the past 9 weeks, going back to the beginning of October, we've looked at a variety of trading methods. We've looked at different aspects of trading, which is the name of the course. We've looked at the fundamentals. We've looked at the macroeconomy. We've looked at technical analysis, analyzing the trend, different technical tools, moving averages, oscillators. We also talked about pairs trading. Last week, we did risk management. And really, this is all about reflecting back on that, talking about how we can maybe bring it all together, and a bit about the actual markets that we might trade. As usual, though, I would just like to bring your attention to the disclaimer, which is very important that you read and understand. Please just take a moment to read through there. And I would just like to stress that everything we're talking about today in this presentation, everything over the whole of the course, is all just for education purposes. It's all about providing you with information, trying to expand your trading knowledge. None of it should be taken as a recommendation or any kind of investment advice. If you've had a chance to read through that disclaimer, then we will move on next to looking at the agenda for today's talk and what we're going to be covering. So we'll have an introduction, just going over a review of the things, trying to jog your memory perhaps over some of the things that we have covered. And then we're going to be talking about building a trading process, some of the things that are involved in that. And a lot of the strategies that we've looked at are about picking markets, which markets look like they're interesting for trading, but building a trading process incorporates a bit more than that. So we'll be talking about that. And we'll be talking about deciding which instruments you might want to trade. So we'll be looking at some of the quirks of the financial markets that are available, some things that you may not be aware of. And we'll talk about getting a winning mindset, finding that kind of attitude towards trading that might help you to win. And then, as usual, at the end, we will have a Q&A session. If you have any questions that occur to you as we're running through, just jot them down, make a note, and then send them through in the Q&A session at the end, and I'll try and address those. So, strategy. It is a set of choices that positions you on a playing field of your choice in a way that you win. Now, this definition of strategy actually comes from it's a definition for business strategy, and it comes from the Harvard Business Review, but I think it applies nicely to trading also. when we're talking here about the playing field of your choice, that playing field are the markets that you choose to trade. And the choices that you make in a way, playing on a playing field of your choice in a way that you win. And the way that you play are the choices that you make in terms of things like what time frame you trade over, what strategy you choose, your risk management that we talked about last week, and so on. So the course in review, we've looked at various elements of trading and investing over the past 9 presentations. And in this final segment, we're going to go over the various topics that we've talked about, putting different parts together into a process or system for trading. Just kind of remind, as I say, jog your memory, start thinking about how the different parts we've learned might fit together. And of course, when we talk about a process or a system for trading, what we're trying to achieve, what we're aiming to achieve, is a profitable process for trading, if we can achieve that. So the course in review, we talked about fundamental analysis. Cast your mind all the way back to the beginning of October. We talked about earnings season, the US earnings season, when we get all the big companies reporting on the heels of each other. We talked about looking at multiples, financial ratios, things like price to earnings growth, price to book, those sort of things. And we also talked about how companies report, breaking down things like the income statement, the balance sheet, and the statement of cash flows. And the kind of things that you can look in that information, things like the free cash flow of a company, important things like that, estimates of growth. And we also talked about doing peer-to-peer comparisons using stock screeners, those multiples, those financial ratios, as a way to winnow out what stocks we're considering for investment or trading. And we also talked about DCF analysis. So that was looking at the net free cash of a company, making estimates of growth rates to calculate a value, future value in today's terms, so that we can work out whether a company looks like it's good value or not, using discounted cash flows. And then we also talked about looking at the macroeconomic news. We talked, if you remember, about how the business cycle, this kind of cyclical process that the economy as a whole goes through, where it expands at times and then contracts once it hits a peak, it begins to contract, and then it hits a trough, and then it starts to expand again. And that's the ongoing cycle of the business cycle. And we talked about non-farm payrolls being the most important event in the monthly economic calendar, how that ties into the business cycle, how it's a proxy for GDP, and so forth. And then we also talked about the FOMC decisions, the Federal Open Market Committee, where the Fed decides on what monetary policy should be for the United States. And then we moved on to talk about technical analysis, looking at breakouts, trend analysis, following the trend. We looked at tools like moving averages that smooth out price oscillations to make it easier to see what the trend is doing. And it also helps to confirm the trend. We looked at volatility envelopes, things like Bollinger Bands. And we talked about retracements. When we have a breakout, sometimes the price can drop back. And then we talked about using momentum oscillators as a way of confirming or helping us improve our trend analysis. So things like the relative strength index, the RSI. If you recall, we also looked at different chart patterns, things like double tops, double bottoms, head and shoulders, and then Japanese candlestick patterns, morning star, evening star, 3 inside up, and so on. And then last week, we talked about risk management and position sizing, that really essential part about not trading too aggressively, not taking on too much, and how if you don't manage your risk correctly, then you can even turn a winning strategy into a way to lose. When it comes to building a whole trading process, what a trading process actually ends up looking like, that's ultimately down to you. But whatever you do choose, you should ensure that it is based on a logical premise. It should be based in reason. And I hope that you would agree that all the various things that I've just been talking about, fundamental analysis, technical analysis, trend following, risk management, these are all ideas that are based in reason. They're based on looking at the evidence, they're evidence-led processes. And what we also want to achieve is that we have a reason to believe that whatever process we have, whatever you do go for, has what is called an edge, which means that it has a tendency to deliver a successful outcome. So if you use your strategy, if you look at what it has done through testing, that it delivers better than a sort of coin flip chance, a 50% chance of success. And that means the whole process, not just the entry signals. So hopefully you'd like each part of your process to actually have an edge, so that your entry signals have a better than 50% chance of success. Your exit signals help improve that. Your risk management helps improve the edge of the process. And we sort of split it out to talk about fundamental or technical as really being the sort of two different pillars of trading. And they, on the face of it, they do appear to be completely opposed in terms of their trading philosophies. But you don't necessarily have to pick one or the other. You can use a mix. And in fact, if you go to any trading desk in the city, I suspect that even the most fundamentally leaning person is probably going to have some charts on their computer in front of them. They will be looking at charts just to give them a kind of guide as to what price has been doing. And conversely, even someone that is very, very technically leaning is likely to pay attention to if a company is reporting imminently, or what, the non-farm payroll is about to come out. That's probably just something they're probably aware of. And so we can use a mix, and what that mix is, once again, it comes down to what you prefer. But you could decide to go down that route of 0% fundamental, 100% technical, just purely using technical methods, not looking at any kind of actual fundamental data, just purely looking at what the price action is, or the other side of the coin, completely ignoring technicals, just looking at the fundamental data that's out there. But if you start to mix it up, you could use mainly fundamental to decide what to buy and sell, but technical to help you with that timing. If you remember when we talked about fundamental, one of the problems was that it doesn't tell you anything about the timing. You can tell that a company appears to be undervalued, but it may remain undervalued for an extended period. So what you might do is, if you've decided that a company, you've got a list of companies, you've done analysis on fundamentally that look like they're good value, you might then look at the charts and decide which one of your little short list looks like it's actually, from a technical perspective, looks like it might be a better time to buy that than some of the others. You might use that just to color your thinking. Or you might use mainly technical for your trading signals, but you might then have a quick look through the balance sheet, have a quick look through the income statement and so forth, just as a sense check, just to say, okay, is there something horrendous that I should know about that might hold my hand? So for this final one, you might, for example, think of something like GameStop, where it was, if you were looking at just what's going on with the chart, you might have seen that looking like it's trending really strongly. But if you looked at the fundamentals, you might say, okay, there's something a bit funny going on. You might think, well, I still want to trade it technically, but be aware at least that this is purely a technical play and that the fundamentals are ropey, potentially. And in terms of, using fundamentals to decide and then technical to help with the timing, could someone just give me any stock? Give me a shout out of any stock. Someone's saying Snap. Let's have a look. Okay, so if we put up Snap, so let's say you've looked through the fundamental research and you've decided that Snapchat, for whatever reason, is a great buy. And then you take a look at the chart, and then you might just say, okay, well, actually looking at this now, I can see that it appears to be breaking out on the upside and that there's an uptrend. So you might draw a trend line on here and see that this very sharp trend, and it appears to be accelerating. And that just might give you greater insights. You might say, okay, the technicals appear to agree. Oh, sorry, I haven't showed the screen. Can you see the screen? Right. Okay. Sorry.
Yes, we can.
Yeah. Okay. Yeah. So here's Snapchat, and you can just see that since the end of October, we can see all these green candles. We can see the price accelerating. I've drawn a trend line on there, but we can see prices actually accelerating away from the trend line. So these would be kind of indicative. You might just take that, as I say, as sort of additional insights. You've already made which is assuming your fundamental analysis to say, okay, this looks good from a fundamental perspective. Obviously, that's not a given, but making that assumption. You're then going to the chart just to say, okay, how does that color my thinking? And if you had decided this was a good buy from a fundamental perspective, seeing this chart might say, okay, yeah, now looks like good time to get on, but slightly wary that when a trend is accelerating this much, maybe it's going to burn itself out. So that might also just give you some additional food for thought. And we also, when we're trading, always want to aim to try and remove the emotional element from trading. This is very hard to remove it entirely, but we do want to minimize our subjective decision making versus evidence-based objective trading rules. And so this once again brings us back to something that we talked about last week, which is position sizing. Remember about trading too aggressively. If you take on a position size that is large, inevitably tends to invoke an emotional response. So if you've got a small position, it's going to be a bit easier it's going to be less stressful, allow you to avoid making irrational decisions. Another way that you can try and strip the emotion out of it is to try and codify your strategy into a technical trading system that makes the trading more a mechanical process, and then that would remove the emotional side. So we're going to talk a little bit about the idea of a mechanical trading process. So the components of a mechanical trading system would include all of these points that are listed here. So your system would say which markets to trade or which markets not to trade. So then and we'd be consistent about that. Remember, we talked about consistency also last time. If you've got a system and you don't know which trades are going to win and which are going to lose, therefore you want to consistently just stick to your rules. The most obvious thing that everyone always thinks about when you talk about a trading system is they think it means which market or an entry strategy, stock picking. And that is a key part, an entry strategy, but we would also need an exit strategy when a position wins, an exit strategy for when a position loses, and it would also need a risk management component a position sizing one, and you'd also need to think about what kind of time frame. So once again, if we go back to the charts, if we look at, say, I'm just going to put the NASDAQ on here. Can you remember when we looked at the volatility envelopes, we talked about Bollinger Bands, and this would be an example of a mechanical trading signal, which we had this one where we said if the price breaks outside below the lower band, then it would be a buy signal. If it breaks above, then that would be a sell signal. And then your closing signal would be when the price crosses through the middle moving average. You'd probably also want a kind of losing signal. So, for example, if we look here in March of 23, we can see the price broke below, and that would be a buy, and then it comes up and you'd have your sell signal to win. But what you would need is also a signal if this carried on going down after you'd bought it. When you're losing, you'd want some kind of stop loss to protect you on the downside. And you'd also, to fully flesh out the trading strategy, want to know how much to trade, which markets am I applying this to, and which ones am I ignoring. You can obviously see in terms of what we're talking about, trading with an edge. And this is, I haven't looked at the actual numbers, but eyeballing it here, we can see it does do a very nice job, the old Bollinger Bands, on this market of picking, if you look at this position in late October, it breaks below the lower band, gives you a buy signal, and then the market then does rally quite soon after. Obviously, then with that trading strategy that I gave you, you might want to tweak it and say that, if my exit strategy is when it crosses the moving average in the middle, that cuts out most of my profit, and we're not doing a great job of trend following there. So there's room for tweaking it potentially to try and improve it, which ties into something we will move on to a bit later on in this talk, which is about backtesting. And just that final bit here is saying that you'll need to decide on a kind of time frame that you're trading, but this may be implied by your entry and exit strategy. Obviously, if your entry strategy is based upon it's not a mechanical, but you're mainly looking at fundamental analysis, then really you're going to be looking at long-term trading time frames almost by the very nature of fundamental analysis. If you're trading technically, then really it opens up all sorts of time frames, because it can be applied to very short trading time frames, including day trading or even scalping. So we have a quote here from Confucius about how the devil is in the details. The mechanic that would perfect his work must first sharpen his tools. So in other words, really, before you're trading a market, you really need to know what you're trading with. You need to be familiar with what you are trading. So deciding which instruments to trade. There's all sorts of instruments out there, many, many instruments that you can trade. There is absolutely no need to trade them all. Just because they're there doesn't mean you have to trade them. You might only trade a couple of different instruments and stick to it. So as I say, it's always a good idea to trade what you know and understand. And you do want to be consistent about what you trade or don't trade. If you are going to trade something new, it follows you need to learn about it. So some of the things that you need to consider, some factors, are things like dealing costs, how much spread for the instrument, how much you're paying on it for daily funding if you're holding a position, and that can vary from market to market. So that is a consideration. Liquidity, different markets can be more liquid than others. Some are less liquid, and that may have implications for how easy it will be to get out of a position or not, what kind of spreads there might be at that time if it's in a liquid market, or how readily it's available to trade. Is it available to trade at all hours of the day? And it may tie into, the more liquid it is, it may help in terms of a technical, trend following. the additional liquidity might or might not help with that. And is a market well suited or ill suited to your strategy? This is sort of talking about that. So, for example, when we talked about trend following, if you find that a market tends to be one that has a history of strongly trending, that's going to be well suited for a trend following strategy. So let's talk about Forex. So the Forex market, the currencies market, is extremely liquid. It's the most liquid markets that you can get involved in. And it's the Forex market as a whole is more actively traded than any other market. So I think the numbers are more than $7 trillion US dollars worth of currency changes hands each day. And estimates of the global value for shares is tens of billions of dollars per day. So it's much, much bigger than the equity market. It's a decentralized market, which means it's over the counter. So it doesn't trade on any exchange. It trades in this thing called the interbank market. And it is a genuinely global market. Because of that decentralized nature, what that means is that it sort of actually follows the sun. So early in the day in the Far East, when the sun is, it moves across the globe. When it's their daytime, that's where the volume is in the Forex market. But obviously around the world, you can access those prices via the interbank market. And as the day continues throughout the sun moving through the west, then it gets picked up in Europe and then London and into the US. So it's a genuinely global 24-hour market. That liquidity is, although the liquidity will sort of change throughout the day, there's still heavy liquidity in the Forex market at any point of the day. And if you compare that to some other markets, will actually close at the end of the day and there'll be a gap where you can't trade them. So that's one advantage of the Forex market. If you are someone who wants to trade at any hour of the day, then the Forex market will offer that to you. The way it works is you're trading one currency against another. So you're always buying one currency, you're always selling another. And that means that it's a good way of, if you've got a view of one economy versus another, then the Forex market very nicely allows you to do that as one transaction if you're doing it as a CFD. Now, the Forex market is made up of a great many Forex pairs. The most liquid currency pairs, the ones that have the tightest spreads as a consequence, are what we call the Forex majors. And these are Euro against US dollar, the British pound against the US dollar against Japanese yen, and the US dollar against the Swiss franc. Obviously, they all involve the US dollar. Also, very heavily traded currency pairs are the Aussie dollar against the US dollar and the US dollar against the Canadian dollar. Sometimes they get sort of lumped in with the majors, but they're also sometimes referred to as commodity currencies, along with the New Zealand dollar against the US dollar. But they're almost, as I say, the US dollar against the Canadian dollar and the Aussie dollar against the US dollar. They are almost like the majors in terms of the volumes that they trade. All of this is actually unofficial, of course, because of the OTC nature of the FX market. It's just really a convention that they're considered this way. And given all the majors involve the US dollar, it means that if there's any news that impacts the US economy, that's going to impact all those currency pairs. So, for example, if there's a strong non-farm payrolls figure, which is bullish for the US economy because it implies that more jobs being added, people are going to have more money to spend, that should have implications for GDP growth, then we might anticipate some drag on the euro against the US dollar because it implies strengthening for the US dollar, so that euro dollar would go down. all things, other things being equal, and the same for the pound against the US dollar, and so on. And the fact that all of these are impacted by what's going on with the US economy, that might have an influence on your thinking if you're trying to diversify your risk by trading uncorrelated instruments. For example, these would all be correlated in some degree just because of that tie-in to the US dollar. And just to give you a comparison of some typical spreads, I've got some bid offers that I noted down here when I created this presentation. So we've got the bid offer for the US dollar against the Japanese yen, and we've got a bid offer for the Swiss franc against the Japanese yen. So dollar yen is a major, Swiss franc against Japanese yen is what we call a cross, a currency cross. Now we can see the spreads, and then the spread in pips, and then as a percentage of price. And we can see that the dollar yen, the major, is really incredibly wafer tight, that spread. Dollar yen, Swiss franc against yen, that's still a tight spread. It's still very, very tight. You know, if you were to compare the kind of things, if you go on a holiday and you try and change some currency at with a bank or something like this, you will be paying hundreds of points of spread there. Spreads are terrible compared to these. These are incredibly attractive spreads, but we can see that the major is much tighter. The reason for that is the reason that Swiss franc against Japanese yen is called a cross is because in the interbank market, that would actually be structured as two trades. You would do a US dollar against Japanese yen and a US dollar against Swiss franc, and you do those two trades to create this cross. So because you're doing two trades instead of one, it has a bigger spread that just is sort of fundamentally part of it. If I go back to the platform, just wait for this to come through. If I look at my currencies watch list here. So here I've got a list of some majors plus some of those commodity currencies. At the top, we've got the South African rand against the Japanese yen. So once again, this is just to highlight the difference in spreads. If we look at the South African rand against the yen, we can see the spread 7.007 as a percentage. We can see that that is much larger than if we were to look at, say, euro dollar, where we've got the spread is 0.0000 something like 9 there. It's almost probably about the spread on the South African rand against Japanese yen is probably 10 times wider. But that's just the nature of the beast. You'll get that everywhere in the FX market because of the liquidity of euro dollar. That tends to mean it get this incredibly tight spread. But that's just something that might factor into your thinking if you're someone who's very high volume trading. If you're scalping or something like that, or day trading, then the width of spreads are going to be so much more important to you than if you're trading long term. Would it be of less importance to you? So this is something I mentioned in passing already, that a forex pair can be a useful instrument if you are following macroeconomic trends and have a view on the prospect of one economy versus another. So it just really dovetails into that very nicely. So if you just happen to have a view about the US economy is going one way and let's say the Eurozone economy is going the other, then you could play that sort of that play would be done very easily by taking a position on euro dollar. There's another trade that is fairly common in the market. It's called a carry trade. So we get this thing, overnight funding, that represents the difference in interest rates between the two currencies. And the carry trade is this yield play where you pick a currency that's particularly high yielding relative to the other pair in the other currency in the pair. So the classic carry trade is going long US dollar against Japanese yen, where the US dollar yield, US dollar interest rates tend to be a lot higher than Japanese interest rates. Has been that way for a long, long time. We're seeing that very much at the moment. So, for example, if you've got the US federal funds rate, let's say at 4.75%, and the Japanese policy rate is, and it's actually a negative rate, let's say minus 0.1%, then if you took a position of $100,000 equivalent of underlying dollar yen at a rate of, let's say, 136.240, that might give you an overnight refund of around about $10 a day, excluding, this is completely separate to any kind of movement in the actual exchange rate. So obviously you're still exposed. If the dollar weakens against the Japanese yen, you're going to lose on that trade, but you're getting each day $10 as a refund with those numbers. So if we go back to the platform, and if I go to dollar yen and I click, let's say, buy here. So if, and I just change this to, I'm going to change this to $100,000 worth of currency. If we look at the bottom, it's saying overnight refund. It's actually, let's just wait for that to feed through. Yeah, overnight refund daily $12.40. That's because the dollar yen rate has increased since I took my numbers. So you can see if you took a position, it didn't really move for a week, you're going to be making $70 odd from just your yield play. Something else that's worth bearing in mind is this idea of the flight to safety. So the yen is perceived by the market usually as something of what we call a safe haven, a safe. When the markets become particularly volatile or stressed, then investors might seek out these things that we call safe haven. So other assets that are typically perceived as safe haven include the US dollar, the Swiss franc, and gold. So we get this thing called the flight to safety, where investors, if you get geopolitical risk, people start getting worried about where do I put my money. You get these flows of cash going from more risky assets into ones that are perceived as being less risky. And this is the flight to safety. So in those kind of times, you often see improvements in the price or flows of cash into these safe havens, like the Japanese yen or the Swiss franc or gold. So moving on from foreign exchange, let's talk a little bit now about precious metals, gold being probably the most high profile of the precious metals. It's often seen, gold, as a store of value. So it can appreciate when inflation is a concern, like the last few years. So let's actually go back to the platform and go to the charts. Let's get rid of our Bollinger Bands. I'm just going to have a look at gold. If we look at a weekly chart of gold and zoom out on it, we can just sort of see how, if we go back a few years on gold, obviously these are very long time frames, but this is what we're sort of talking about when we talk about the effects of inflation and gold. We can see that we've got this long-term trend of gold appreciating in value from down at $1,150 US dollars per troy ounce up to where it is currently, which is up above 2,000 US dollars per troy ounce. So pretty strong performance over the last few years. And a lot of that will be to some degree driven by this idea that inflation has just been so high that people start to seek out gold. And in times where inflation is less of a concern, you may see that being the opposite. Bear in mind, of course, that gold and silver are priced in US dollars, and therefore they are subject to the same factors that influence the strength of US dollar. And this also applies for a lot of other commodities and a lot of other precious metals, or all the other precious metals, including platinum and palladium. They're priced in US dollars. often with gold and silver, you see that same flight of safety thing that we were just talking about with the Japanese yen. So that's something that might be worth just factoring into your thinking about how that might affect risk management in terms of taking on exposure to correlated markets. So if you're trading gold and silver and the yen, they might behave similar ways according to the way whether the market is what we call risk on or risk off. And then moving on to oil. Oil's always an interesting one because it is so very reactive to supply issues. So, for example, OPEC making decisions on whether to increase or cut output, that obviously has a major influence on global supply, but also if you have conflict in oil-rich regions, and obviously we're seeing, unfortunately, things like that at the moment, oil can be very reactive to those kind of things because if you've got conflict in those areas, then that poses a risk to supply from those regions. And then commodities are always very reactive to supply and demand news. So oil, like gold and the other precious metals we talked about, is priced in US dollars. So once again, it's just this effect of the strength of the US dollar. If the US dollar is very, very strong, that can have an implication for the price of oil. Something else that we should bear in mind with all commodities is that, or most commodities, for example, cocoa, corn, and so on, they're based on futures contracts. I did talk about this a little bit last week. Sometimes they can have low volumes, and then you get this possibility of supply squeezes. You can see quite dramatic price moves as a consequence. And you can sometimes see this phenomenon where prices on underlying exchanges go what we call limit up or limit down. If it moves more than a certain amount, then the market sort of automatically calls time on it. Everyone gets a chance to calm down, and then trading will resume. But when it's limit up or limit down, you will not be able to trade those markets. It's also worth bearing in mind that these contracts are based, as I say, on futures contracts. Those futures do have expiry dates. It's a really useful thing to know if you take a position in a market that has an expiry date, when that might be, just to try and stave off any potential surprises. And I think this might be one of the final things we're going to look at in terms of different markets, stock indices. So a stock index is something that reflects the price overall of a kind of basket of stocks that are within it. So, for example, the FTSE 100 looks at what are the top 100 companies in the UK by capitalization, and then it applies a certain weighting to work out, give you an overall value that reflects how they're doing. And then it makes it very much easier for people to follow, how those top companies are doing, and using that as a proxy for really how the economy is going. And then, of course, people then can trade that index as a sort of convenient way of getting exposure to the top companies all at once. So it's very useful if you actually have a broad view on a single economy rather than having the granularity or a view on a single company. So you might not have any kind of insight into wanting to trade a particular one or two companies, but you do have a view that France is going to do particularly well. Then you would seek out the CAC 40. And also, if you have a broad play in mind, don't forget that you can also trade industry or sector ETFs, exchange traded funds. They're really kind of the similar kind of idea as an index, where they trade just like a share in ETF, but it actually is priced according to a certain idea or rule. So it would incorporate the fund might be compiled to try and reflect the performance of a certain industry. It can be compiled to reflect quite a wide range of things, really, but they're very useful for these kind of broad plays, but maybe not quite as broad as an index as a whole that sort of reflects all the top companies. And it's worth knowing how broad an index is and how it's actually compiled, rather than just kind of blindly trading it without any kind of idea. It's actually worth digging into the detail, just trying to work out okay, the Dow is a famous index. What exactly is the Dow Jones about? And how does that compare to, say, the S&P? So, for example, so we've got it here. The Dow Jones 30, it's actually more well-known than the S&P 500, the SPX, but it has less breadth. It's only made up of 30 companies, whereas the S&P 500 is made up of 500 companies. Therefore, it's less representative of the broader US economy. If you were looking to trade one of these indices, because you had a view on the broader US economy, the S&P almost invariably is going to give you that better representation because it has the greater breadth. And then also the Dow Jones Industrial Average historically has been compiled the same way, which means that it has these some slight peculiarities, some quirks. Dow Jones is only 30 stocks in it. 9 stocks, just 9, account for half of that index in terms of its where the price of the index comes from. And the slightly odd thing about the Dow Jones, a very unusual thing for most indices, is for them to be weighted according to capitalization. It's a very logical way to do it, and that's the way the S&P 500, the SPX, works. But the Dow Jones doesn't work that way. It's actually what we call price weighted. It gives a greater weighting according to the share price. If you've got a big share price, you get a big price weighting. If you've got a small share price, you don't. What the share price is to a great degree quite arbitrary. So, for example, a quirk of this means that the price weighting aspect of the Dow Jones means that United Health has far more weighting in the index than Apple, even though Apple is about 5 times bigger in terms of market cap. It's simply because United Health has a big share price. Something else worth bearing in mind when you're trading an index, when you trade it, shares go what we call ex-dividends. So some companies pay dividends, some don't. When a company does pay a dividend, let's say there's a company, it's 100 pence per share. If it pays out a 5p dividend, when it goes ex-dividend, it's a certain date where the dividend is taken out of the share price and you qualify for that dividend if you hold the share, then the share price will drop by that dividend when it goes ex-dividend. So an index which has lots of shares in it, who might not be, you might have several components of the index paying out dividends at the same time, that might have a substantial effect on the index. The index will drop by the dividends coming out of it. So that's something that's just worth bearing in mind. Might be worth looking at the detail if you're trading, say, the FTSE. Is there a certain week where there's going to be a large amount of dividends coming out? Does that make a difference? For example, I've put here, if you're placing a tight stop, that might factor into your thinking. And then moving on, so that's the end of talking about the different quirks of different financial markets. It's something I quite like. Moving on to finding a winning mindset. So I've got this quote. There's a very famous trading book called Reminiscences of a Stock Operator. It was written quite a long time ago, and it's ostensibly a work of fiction, although it's very, very heavily based in fact. Written by a man, or his pen name was Edwin Lefebvre. He was actually someone who dealt in the stock market in Wall Street in around about the time of like the 20s and 30s. And the quote is, a speculator must concern himself with making money out of the market and not with insisting that the tape must agree with him. So what we're talking about here when we talk about the tape is that it means ticker tape, which is the list of the latest prices on Wall Street. In other words, this is talking about, well, the ticker tape is a representation of what the market is doing. So we've got to, sometimes people get sort of obstinate or stubborn about, I must be right, even though the market's telling them the opposite thing. So that would be the idea that they're insisting the tape must agree with them. Really, you've got to be kind of neutral and just remember the only thing that you've got to do is make money. It's not about proving how clever you are. If you've got something that works and it's a pretty dumb thing, you can stick with it. So just, it sounds incredibly obvious. It's very much a truism, but you are concerned entirely about making money when you trade. And number one mantra is you're in this to try and make money. So you're not here to try and have fun. You're not here for the excitement. You're not here to prove how clever you are. If you want to trade for those reasons, of course, you are free to, but they are nothing to do with making money. And if you find something that simple works, then there is no need for complexity. So look, first of all, for easy wins. It may, if you find an easy win, there's no need to try and look further. There's no need to try and refine it or make it better or look for some other clever way to win. As long as the thing that you've got works, stick with it as long as it carries on making you money. £100 won by a simple, obvious strategy is the same as £100 won by a complicated trade. So look for that low-hanging fruit if you can find it. And also beware the sunk cost effect. Unfortunately, being human beings, we are susceptible to these psychological weaknesses. And one of those psychological weaknesses is this thing called the sunk cost effect, the tendency that we have to want to throw good money after bad. You should try and avoid that. So if you've opened a trade, often we sweat buckets, thinking up a clever strategy, trying to find something that works. We try it out and it goes wrong. You don't have any loyalty to that trade just because you put a lot of time and effort into trying to think up that trade. If it's going wrong, that's cutting into your capital and you need to think about getting rid of that trade. So if it's obviously gone wrong, it's clearly gone wrong, forget about having loyalty, move on to the next trade that might be a winner. And remember that the profitability of your strategy is the aggregate of profit and losses. So it's all your losses and all your profits combined that are going to define whether you're making money or not any one trade. But if you let a loss grow, if you've got one trade that you stick with stubbornly and its losses are getting worse and worse, that has a serious implication for how large the profits are going to have to be for the ones when you win. They're going to have to be so much bigger just to get back what you've thrown away by sticking with the losing trade. So, sticking with that losing trade in the blind hopes that it might go right is throwing good money after bad. So try and avoid doing that. And so if you've come up with a strategy, so it says here, show it no love until it shows you some. So until it starts making money with you, you might want to change it or move on to a new strategy. And if it does start making money for you, that's when you stick with it. And be skeptical about your strategy. Just assume that just because you've thought it up doesn't mean it's going to work. Be skeptical. Try and find the holes in it. Kick the tires. Try and find where the weaknesses are. Prove that it doesn't work. And if you can't prove that it doesn't work, then maybe it will work. And then maybe you can stick with it. So I have a quote here from George. We had a quote from him last week, George Soros, the very famous hedge fund manager. He's saying making an investment decision is like formulating a scientific hypothesis and submitting it to a practical test. And so the real acid test, of course, is how your trades perform in the real market. But this idea of testing or treating your prospective strategy as a hypothesis is a good, sensible approach, really, for any potential trade. To approach it with a neutral disposition, you don't assume it's going to work. You're trying to look whether you can disprove your hypothesis, disprove whether your strategy is valid or not, or whether you can prove its veracity. So this might even be you might just be a situation where you anecdotally think you're hearing about a stock that makes you think it might be good. The classic one at the moment is like Novo Nordisk, who makes like Ozempic and other diets helping drugs. that has been doing really well. It's been making news all year. You might just think, okay, so the starting point is that, is this something I might potentially want to invest in? Well, take a completely neutral approach. The hypothesis is this could be a good stock because I've been hearing all about it and it seems to have this product that everyone likes. And then that could go just the test there might be to go and look at the fundamentals, dig out its balance sheet, dig out its income statement and its statement of cash flows, and actually look through what free cash does it got, what is its cash from operations, how does that compare to its net income, and all those things that we talked about. But also testing for can be with a mechanical trading system, can be about back testing. So whatever system of trading rules you decide on, it's important to have confidence that you're using something that works. We talked earlier on in this presentation about you want something that's got an edge. So back testing your system with historical data will help build your confidence, because that is going to be, once you're into actually trading for real, then really your nerves are going to get shredded at times. Having confidence that you've proven that this thing has a good percentage chance of working will help you stick with it. And also, when you test, it will help you ditch what doesn't work. It will help you winnow out strategies that don't really work very well, or help you fine tune, help you improve what does work before you do it for real. So once you've done your back testing, you've established a testing record of what drawdowns to expect. So you can see like how deep the losses might be at times. That will help you to deal it makes it easier to deal with that psychological tough thing of hanging on to, trying to make that decision. Is it the trading wrong? Should I stick with it? Or is this within what we would expect, given the historical record of this trading strategy? Historical data, of course, I always say this, it's not a guarantee of future behavior. Just because it's behaved like that in the past does not mean it's going to do the same thing in the future. The regulators are always keen on pointing that out. But if you look at what real world data we've got, it's the best thing we do have to look at. You haven't got much else to look at. So it doesn't guarantee future behavior, but you would tend to think it has some usefulness. So if you've gone through the whole rigmarole, you've got your hypothesis, this is my strategy I think might be worth using, and then you test it, you try and poke holes in it, see where its weaknesses are, back test it, maybe tweak it, optimize it, make it better. It seems to work. Then it's time to actually try it out for real. But when you do, remember what we talked about with risk management, about not being too aggressive, thinking about your position sizing, keeping things small when you're starting out, dipping your toe in the water. And then if it does work, there's plenty of time later to gradually increase your size as you gain confidence in the strategy, as you've established that it does work. And if it does work, then stick with it. Quick word on costs. Once again, I mentioned this in passing, that how much of costs are an issue to you? It's a function of the time frame you trade over. So if you're trading over, if you're a day trader, the bid offer spreads, they're going to be something that's very much a major concern for you. But if you're trading longer term, then the size of the spread actually starts to become less important. Funding costs, if you're opening and closing on the same day, then funding costs are going to be completely irrelevant to you. They're inconsequential. They don't make any difference to you. If you're holding a position a long time, then the funding costs are going to be important. It's worth just having an idea of what those are. Do the put the extra, go that extra mile just to work out what all your costs are. And of course, costs aren't just things like spreads there and holding costs. Costs are also the cost to you in terms of personal time. When we talked about fundamental analysis, it's a time-consuming process. And that means if it's worth your while, you have to be able to make a certain amount of money. When we talked about discounted cash flow analysis, we talked about a thing called the risk-free rate of return, and that has to be something you're thinking about. If the risk-free rate of return is 5% and you're making 3% and spending hours each day doing your fundamental analysis, then that's not great, because you're wasting your time and you're making less than you could make just by investing in something like a good investment account or trading in a treasury bond. And just think about all these costs combined, how they might typically expect to the costs you might typically expect to incur, how they might affect your profits and losses, because they are all part of it. Just something to bear in mind. So here's just something that compares. I've got some sample quotes I jotted down here, show you what the spread are. So we've got a mix of markets here. We've got some FX, got gold, got oil, the UK 100 index, the SPX 100. Sure, that should be the SPX 500, Intel, and then I've got the spread as a percentage of price, and then I've also put down a 22-day ATR. So this is giving you an idea of the volatility of that market, how much it tends to move. And then we've got spread as a percentage of ATR to try and give you a kind of feeling of how cheap or expensive they are in terms of compared to how much they move. And we can see that with some of them, there's just, once again, I use this word, they're like wafer thin spreads, where you're paying very, very tight spreads. It's tight, 1% of what it would move on average in a day. So it's very easy to make that spread back in a heartbeat. Something like Intel, a little bit less cost effective in terms of spread, but that's just the nature of the beast. The indices and the FX, they're just incredibly tight spreads. And really on something like Intel, that's a very competitive spread because it's a market spread part. That is part of the inherent market rather than anything else. Okay, so summary of what we've been through. We've covered all sorts of different analysis methods. Just use what you think, what you feel comfortable with, what works best for you. Don't forget, you've now got at your disposal a whole variety of tools that you know about, and you can use them in a different combination of way. The sky is really the limit. You can be very inventive about this, about how you use these different methods. We talked about, you might do your fundamental analysis to give you an idea of whether you want to buy something, and then use technicals to try and do the timing. But also you might do compare the stock in question with its peers using some valuation ratios, and then you might use your knowledge about pairs trading to maybe hedge your position a little bit against something, not a full pairs trade, but a partial, so you're not overlong against that stock. All sorts of tricks that you could do, because the knowledge you've now got is pretty expansive. A trading system can help remove the emotional aspect. So be trying to think how well you can codify what you're trying to achieve before you actually place the trade. So you're not just trading on the hoof. There's some kind of thought process behind it before you even place the trade. Back testing can help give you that confidence you're going to need. It can help you provide clues whether a system works, whether you can optimize it perhaps. And do decide which markets you're going to trade in advance and which ones you're not going to even consider, which ones are excluded from your trading strategy, and then stick with that to give you the consistency every time you trade, and just keep an eye on those costs. So that is the end. Let me just check the time. We've got enough time for some Q&A, so I'm going to try and dive in here and see what we've got. Higher highs.
The best question that was while you were talking is, Peter, where are you? I mean, you always get a daylight when we're here at the start. So I said, well, Peter is at Canada. So
yeah, I'm in Atlantic Canada. So it's about 4 hours behind the UK. So that's why it's daylight still here, but not for much longer, because the days are so short that it won't be long before it's dark here.
Yeah.
Let's have a look at some of these questions. I'm more or less a message. I think that question, I'm just going to think it's outside the scope of what I've been talking about. So I will move on to see if I can find something a bit. Okay, so someone asking, with the current price of gold, do you think this is a flight to safety or more of a technical move? Great question. I always like to say this, it's always the great questions are the ones that are actually really tricky to answer. Well, let's go and have a look at gold and see what we can see. Okay, so we've got the gold chart there. And so current price of gold. I mean, I think very much, I would say, right, I'm going to move it to a bit shorter time frame because that's really, really long that we're looking at. That was to just show you how it moved over the period of years. But let's I think, I mean, a lot of this, I had to hold my hands up and say, this is my supposition. It's not based on knowledge. But if you look at what it's been doing technically since, I mean, there's I would say evidence of safe haven behavior there. Just in what we've been seeing of late. So I mean, this is going back a whole year, and the general, I mean, I would, to try and analyze this properly, I'd probably add on some moving averages to confirm what you're seeing in terms of the trend. I suspect, just eyeballing it, that we're seeing really a combination of the things that we're talking about. So we're seeing over that last year probably a reaction to I'm not so sure technical, but it's a reaction to inflation, which is a big driver for gold. But then when we're seeing this sharp push up here, where we got October through to where we are now, I imagine there's an element of events, geopolitical events, driving some safe haven behavior into gold in that push there. Technical always is just price movement, so we can always analyze this technically, and so that's the thinking behind technical analysis. We don't need to sort of know the why. We can just see what is happening, and we should be able to analyze it technically from that behavior. So obviously we are over there, we would say the last couple of months, depending on what kind of time frames you're looking over, we can see that it wasn't pushing higher. It was more sideways or even a downward sort of medium terms trend there, but then big rebound and pushing up to fresh highs that are well above where we've had previous resistance, suggested some kind of a technical bounce. But let's go back to let's see what other questions. Okay. It's quite good. I quite like this question. It says, hello, Peter. Great course, by the way. Thank you very much. This question might have been better for another module, but from a technical analysis point of view, what would you say are the most used indicators or the most reliable up to 5? I, for example, like to look at volume, RSI, MACD, and Bollinger Bands. Well, I would say, I would definitely say RSI has got to be up there in terms of most used. I'd probably caveat that with most misused as well. I think it's useful, but you've got to use it the right way. MACD is popular. I know lots of people who like MACD. Personally, myself, I don't find it quite so useful. I do Bollinger Bands. I would agree with you. So, I mean, you yourself have said RSI Bollinger Bands. I completely agree. Bollinger Bands wildly popular, and I think very useful as well, to be honest. Myself, my own personal favorite is always just your simple moving average. I think it's just the most useful. I would suspect it's the most widely used and most frequently used technical tool. But I'm a kind of meat and two veg kind of guy when it comes to technical analysis. I like trend lines. I like moving averages. I like support and resistance. Those aren't technical indicators necessarily. Moving averages are. But those are the kind of tools that I think are really the the simplest and most robust tools available to a technical analyst. I think oscillators are really useful. So they're all sort of take your pick. So I think RSI or stochastic, I mean, I would probably lean towards RSI as being more useful there. MACD, as we've said, is very popular. So top 5, RSI, MACD, Bollinger, simple moving averages. And I would just say moving average crosses as a separate tool as what I would just off the top of my head say as a top 5. I'm not sure about that question.
I think you covered most of them.
Yeah.
If there are no more questions, first I want to thank Peter for all those 10 sessions, which were amazing personally
you.
for me, and I'm sure for many of you. And obviously, thank you, our clients. We hope you enjoy it. And yeah, we know that a lot of you are, well educated, but I'm sure even if each one of you took one thing from this course, it pays off because in finance you study every day. So I really want to thank you guys. Thank Peter personally and from all the team, and I'm sure you guys enjoy it. As I wrote in the beginning, we will send you guys a survey so we can improve for the next course we're gonna do with Peter. And obviously, it's a new year. It was a really interesting year, challenging year, ups and downs. And we're coming up next week with the annual investment outlook of eToro's analyst team. So get ready for that. I can give you a hint that the topic is about how important it's to rebalance your portfolio in 2024. We're going to have a busy year. 70%, if I calculate right, of the population in the world are going to be voting for a new president or some election. We're still gonna have geopolitical issues and so many things. So very important. So stay put. We will send it in email to all our clients so you can watch it. So again, Peter, thank you so much. Really, thank you for
My
this, and
pleasure.
thank you, our
Thank you.
clients.
Yeah, so I'd just
Thanks.
like to say to everyone, give yourself a pat on the back for completing the course. You've made it to the end. Well done. And thanks very much for everyone who took the time to attend. I'll see you next time.
Yeah, and I'll just reply one thing because someone dropped the last question about the certificate. So again, as I mentioned, I mean, to be entitled for the certificate, you need to cross 80% of the course, which is 8 lessons. It doesn't matter if you watched it live or on demand. Our system knows to track it, and it's you still have time to do it, whether you didn't complete it. I'm dropping now the link in the chat. You can just get in and watch it in the next week or so. We are gonna send the certificates probably by the end of the first week of January. So that's when you can expect for that. And should you not get in it or you have any problem, again, that's why as our valued club members, you guys have an AM account manager. So you can always contact him and obviously we will reply. And as I said, this is only the first course. We are going to have more with Peter. So,
Cool. All right.
okay,
Well,
guys.
thank you.
Thank
Thank
you.
you.
Thanks.
Bye-bye.
Bye-bye.